Imagine you have a magic money machine that can generate cash for you in the future. You have to decide whether this magic machine is worth investing in or not. The concept of net present value, NPV, helps you figure out if it's a good idea to put your money into this magical opportunity. In our financial journey, time is like a magical force that affects the value of money. Money today is worth more than the same amount of money in the future. Why? Well, because if you have money today, you can put it to work, like investing or saving, and make even more money with it. Let's take an example to understand this better. Suppose your friend offers to give you $1,000 a year from now. That sounds great, right? But before jumping with joy, think about it for a moment. What if you had that $1,000 right now? You could use it for something valuable, maybe invest in a small business, buy something you need, or even save it in the bank to earn interest. So, getting the money sooner is more beneficial because you can put it to good use. Now, let's add another twist to the story. What if your friend said, "Hey, I'll give you $1,000 a year from now, but only if you give me $900 today." Would you take this deal? The answer depends on how much you value having that money sooner rather than later. It seems like a good deal because you're getting more money than you're paying, right? This is where net present value, NPV, comes into play. It's like having a crystal ball that helps you predict the future value of money and make smarter financial decisions. NPV is all about finding out the current worth of future cash flows. In our magical money machine scenario, you need to consider not just one payment but multiple cash flows over time. Let's say your friend promises you $1,000 every year for the next 5 years. Now, you want to know if investing $900 today is a good deal or not. To calculate NPV, you need to use a special formula that takes into account the interest rate, also known as the discount rate. The discount rate reflects the magical power of time and helps determine the current value of future money. If the interest rate is, say, 5%, it means that money will grow by 5% every year. So, $1,000 next year would be worth less than $1,000 today, and each subsequent $1,000 will be worth even less as time goes on. By calculating NPV, you'll find out whether the total value of all those future $1,000 payments, discounted back to today's value, is more or less than the $900 you need to invest. If the NPV is positive, greater than 0, then congratulations. You've found a good deal that will make you richer over time. If it's negative, it means you're paying more for the future cash flows than they're actually worth today, and it's probably not a wise investment. In the real world, businesses, investors, and even governments use NPV to analyze projects and make decisions about where to invest their money. It helps them separate the magical opportunities from the not-so-magical ones and choose the best path to grow their wealth over time. So, next time you encounter a magical money-making opportunity, remember the concept of net present value and let it guide you towards the wisest financial decisions.